Today, we are going to explore whether the Motley Fool 100 Index ETF, TMFC, is a viable option for investors seeking growth opportunities. Before delving into the financial details, let's first examine the philosophy behind this ETF. According to TMFC filings, it tracks a proprietary rule-based index designed to monitor the performance of the 100 largest, most liquid U.S. companies recommended by TMF's analysts and newsletter. Reviewing the current holdings reveals that 42.86% of their investments are in technology stocks, with the second largest holdings in consumer cyclical and communication services sectors. The most reliable benchmark for evaluating an actively managed ETF is to compare its returns with those of the S&P 500 and the Nasdaq 100 index. Additionally, we will assess the maximum drawdown experienced during the COVID-19 pandemic and recent drops in 2022. Over the past 5 years, TMFC has outperformed the S&P 500 but not the Nasdaq 100. However, during the last 2 years, its performance has lagged behind both the S&P 500 and Nasdaq 100. As indicated by the charts, its performance is more closely aligned with Nasdaq 100, QQQ. Its beta is closely correlated with QQQ, with a value of 1.14, compared to QQQ's beta of 1.18. In conclusion, do we recommend investors to purchase TMFC? The answer is no. Although it is possible that this fund could deliver better returns in the future, based on the available data, there are several reasons we do not recommend this fund. Firstly, its expense ratio exceeds that of both SPY and QQQ, which are passive index-based funds that tracks S&P 500 and Nasdaq 100 respectively. SPY and QQQ boasts expense ratios of 0.09% and 0.20%. While TMFC's expense ratio stands at 0.50%. In the long term, this 30 to 40 basis point difference can have a significant impact. Secondly, QQQ appears more appealing due to the Nasdaq 100 index's inclusion of companies at the forefront of innovation. Conduct thorough research and make informed investment decisions. Happy investing!